Welcome to the Deep Dive, the show where we cut through the noise and get straight to the core of what you really need to know.
Glad to be here.
Today, we're plunging headfirst into a world that, while often unseen, touches every single one of us. The vast, intricate network of logistics and freight.
It really does.
Think about it for a moment.
Right.
Everything you eat, wear, or buy moves through this complex web, from raw materials to finished products landing on your doorstep.
It's absolutely fundamental.
And while it might seem like just trucks on roads, it's a constantly shifting landscape full of surprising challenges and, well, incredible opportunities, too.
That's absolutely right. It's a foundational industry, the very arteries of our economy, but it's far from static. What's truly fascinating here is observing how companies navigate its inherent volatility and relentless pace of change.
Absolutely. And our topic today is a perfect example of that navigation. ArcBest Corporation, ticker ARCB.
A major player.
They're a major player in this complex world, and we're going to explore their unique position, their strengths, their challenges, and what their journey tells us about the broader economy. Our mission, custom tailored for you, is to deconstruct ArcBest's strategy, separate the temporary cyclical pressures of the market from the deep-seated structural realities of their business, and understand their path forward.
Yeah, cutting through that noise is key.
We've pulled insights directly from a comprehensive investment analysis to give you that data-driven edge, helping you connect the dots in a way that goes beyond the headlines.
By the end of this deep dive, you'll have a clear, data-driven perspective on a critical industry. You'll gain insight into how a company navigates intense market shifts, and we'll uncover some truly fascinating strategic decisions being made behind the scenes.
It's not just about one company, is it?
No, not at all. This isn't just about ArcBest. It's about understanding the pulse of the economy and the intricate dance between tradition and innovation through the lens of freight.
All right, let's dive in. The transportation and logistics gauntlet. Industry dynamics and market position. So let's start with the big picture. The U.S. transportation and logistics industry. It's not exactly smooth sailing out there, is it?
No, definitely not.
We're hearing terms like significant flux and a protracted freight recession since late 2022. What exactly does that mean for companies like ArcBest and, more importantly, for us, the consumers?
It means they're operating in a very challenging environment. The term being used to describe this period in trucking is stagflation.
Stagflation in trucking, how does that work?
Imagine shrinking freight volumes, fewer goods needing to be moved, combined with persistent high inflation for all the critical inputs.
Okay, so less stuff moving.
Right. And at the same time, we're talking about rising costs for labor, for fuel, for equipment.
Yeah.
So you have soft demand, subdued volumes, and carriers are facing significant margin pressure because their costs aren't coming down.
Squeezed from both sides.
Exactly. This dynamic is the dominant macroeconomic backdrop affecting every participant in the industry right now, squeezing profitability from both ends.
So when we talk about stagflation in trucking, it's not just an industry term, is it? It's a direct lever on our wallets.
Absolutely.
The moment logistics costs are high and volumes are down, we start seeing it in the grocery aisle, in the availability of new electronics. It's that invisible hand touching every product we buy, explaining why our everyday purchases might feel more expensive or harder to find.
It absolutely is. That's a powerful connection. This directly influences the consumer experience and overall economic health.
So within this challenging climate, let's look at the major sectors of the industry. ArcBest's core business is less than truckload, or LTL. For those who might not be familiar, what exactly is LTL and why is it so fundamental to this discussion?
Right, LTL. It refers to shipments that don't fill an entire truck. So instead, a carrier consolidates multiple smaller shipments from different customers onto a single truck.
Like ride-sharing for boxes?
Kind of, yeah. Moving them through a hub-and-spoke network. Think of it like a shared ride for freight, or a highly complex jigsaw puzzle, where a carrier picks up pieces from multiple clients, sorts them at a central hub, and then reloads them onto trucks destined for various endpoints.
Okay, that sounds complex to manage.
It is. This makes it incredibly efficient for businesses shipping smaller quantities, but it also demands a robust, extensive network. You need those hubs and spokes working perfectly.
And how big is this LTL market? Is it a sprawling open field or more concentrated?
It's substantial and quite concentrated. We're talking about a $114 billion market just for 2025.
$114 billion.
Yeah, and projected to grow to almost $140 billion by 2030. That's a compound annual growth rate, or CAGR, of over 4%. Steady, almost guaranteed expansion, even with market ups and downs.
Steady growth. But concentrated, you said.
Very. What's really key here is its oligopolistic structure. Unlike other parts of trucking, the top 10 carriers dominate a significant majority of the market's revenue and capacity.
So a few big players call the shots.
Pretty much. This means a few large players hold most of the cards, creating high barriers to entry for new competitors. You can't just jump into LTL easily.
And then in 2023, we saw what was described as a seismic event in the LTL space. The bankruptcy of Yellow Corporation. How significant was that, really?
Oh, that was truly critical context for the industry, especially for a company like ArcBest. Yellow was a major LTL carrier, a huge name.
Right, they were massive.
And its sudden departure removed a substantial amount of capacity from the market almost overnight. This isn't something you see often. It was an unprecedented event for such a large player to simply vanish.
So a big hole opened up.
A huge one. It created a rare, large-scale opportunity for the remaining players like ArcBest, Old Dominion, Saia to absorb Yellow's former market share, fundamentally reshaping the competitive landscape.
And allowing the stronger ones to get stronger.
Exactly. It allowed stronger, more disciplined carriers to solidify their positions. It was, in essence, a forced consolidation, a real earthquake, like you said.
Wow, okay. Beyond LTL, there's also the truckload, or TL sector, which is relevant to ArcBest's asset-light operations. How does that compare to the LTL market in this current climate? Is it feeling the same pain?
The truckload market is a different beast entirely. It's arguably in an even deeper cyclical trough than LTL right now.
Deeper. Why is that?
Well, it's highly fragmented. Get this. About 95.5% of carriers operate 10 or fewer trucks.
95%. That's incredibly fragmented.
It is. This extreme fragmentation leads to intense competition and significant price volatility, particularly for spot rates. Those are the prices for immediate one-off shipments.
And those spot rates are low.
Depressed, often falling below what it costs carriers to operate their trucks. We're also seeing low new orders for Class A trucks, the big rigs, as fleet operators delay investments.
So not much optimism there.
Not in the near term. The American Trucking Association projects only a modest 1.6% growth in truck volumes for 2025, and that's after 2 years of declines. It's a challenging environment for TL carriers, far more susceptible to the immediate fluctuations of supply and demand.
Okay, so LTL is tough, TL is maybe even tougher. And then you have the third-party logistics, or 3PL market. This seems like the real growth engine of the broader logistics world. Is that right?
It absolutely is.
Okay.
3PL is huge. It encompasses services like brokerage, managed transportation, and even more complex supply chain solutions. It's a vast global industry valued at over $1 trillion.
$1 trillion. Wow.
Yeah, and this sector is projected to grow robustly at an 8 to 10% CAGR through the end of the decade.
What's driving that kind of growth?
The drivers are clear, increasingly complex global supply chains, the relentless rise of e-commerce demanding more sophisticated fulfillment, and the strategic imperative for businesses to outsource their logistics functions.
Companies want to focus on their core business, right?
Exactly. They want to reduce costs, enhance flexibility, and focus on their core competencies, making 3PLs indispensable partners. They're the orchestrators behind the scenes, managing all that complexity.
So we've got this challenging current climate, but beneath the surface, there are powerful long-term trends at play, aren't there? One of the biggest is the continued penetration of e-commerce. How does that fundamentally alter freight patterns and favor LTL specifically?
E-commerce is a massive game changer. It shifts demand away from large, infrequent bulk shipments, which are typically suited for truckload.
Right, like stocking a whole store.
To smaller, more frequent, and geographically dispersed shipments. Think about your own online orders.
Yeah, little boxes showing up all the time.
Exactly. And that profile is perfectly suited for the hub-and-spoke model that LTL carriers excel at. When you order something online, you expect it quickly, and it often comes from a regional distribution center or even a micro-fulfillment hub close to you.
Ah, so the rise of those local warehouses helps LTL.
Directly. This build-out of regional infrastructure directly reinforces the demand for regional and super-regional LTL services. It's a secular tailwind for the LTL sector, fundamentally reshaping how goods move towards the end consumer.
That makes a lot of sense. More individualized packages mean more complex routes, often closer to the consumer. What about shifting global trade dynamics? We've heard a lot about nearshoring. How does that play in?
Nearshoring is another significant trend. There's a noticeable move by companies to diversify supply chains away from China, looking for more resilient and often closer manufacturing locations.
Like Mexico.
Exactly. This has elevated Mexico to become the largest exporter of goods to the United States. This directly increases cross-border freight volumes and the need for seamless logistics solutions between the two countries.
Is LTL a big part of that cross-border traffic now?
Well, while the LTL industry currently has lower cross-border exposure compared to the truckload sector, this trend represents a significant long-term opportunity for carriers with strong U.S.-Mexico networks to expand their reach and services. It's something they're definitely watching.
Okay, a future opportunity there. And finally, when will things really pick up for the LTL sector specifically? Is there a key catalyst everyone is waiting for?
Yes, there's a general consensus on this. Industry executives and analysts largely agree that an eventual rebound in the industrial economy, particularly in manufacturing, is widely viewed as the primary catalyst.
So factory output is the key.
Pretty much. That's what's needed to pull the LTL sector out of its current trough and into a new growth cycle. The demand for raw materials and manufactured goods directly fuels LTL volumes. So until manufacturing truly picks up steam again, LTL growth will likely remain subdued.
Got it. Beyond economic trends, external forces like regulations and technology are also shaping the industry. Let's talk about decarbonization. It's a massive global push, but what does it mean practically for trucking?
Decarbonization is a significant long-term regulatory focus, no doubt. The transport sector accounts for about 23% of global energy-related CO2 emissions, making it a prime target.
So governments are pushing hard.
Yes. The U.S. has a national goal of achieving a net-zero greenhouse gas transportation system by 2050. And landmark legislation like the Bipartisan Infrastructure Law and the Inflation Reduction Act have allocated billions to support this, things like funding for EV charging and incentives for low and zero-emission commercial vehicles. The pressure is definitely on carriers to move towards greener fleets.
That sounds like a huge undertaking, billions of dollars. But for a company like ArcBest with practical daily operations, what are the real immediate obstacles? Is this something they're tackling head-on now, or is it more of a distant cloud?
That's a crucial distinction. In the near term, the obstacles are formidable. The total cost of ownership for zero-emission vehicles, like electric or hydrogen trucks, can be up to 40% higher than for traditional diesel trucks.
40% higher, that's huge.
It makes the economic case very difficult right now. And, maybe more critically, the public charging and hydrogen fueling infrastructure needed for long-haul commercial applications is, well, virtually non-existent outside of some pilot programs.
So where do you charge a giant electric semi on a cross-country trip?
Exactly, that's the problem. So while ArcBest is taking early steps by piloting Class 8 EV semi-trucks, it's a multi-decade transition with immense capital requirements and technological hurdles that are largely outside any single carrier's control.
So it's more than just buying new trucks.
Much more. Most carriers are still focused on improving the efficiency of their existing diesel fleets in the interim, because the widespread adoption of EVs for heavy trucking is still a long way off.
Okay, so decarbonization is a long-term challenge. What about technology itself? It seems to be a major competitive battleground right now, transforming how freight actually moves. What are companies investing in?
Oh, it's absolutely crucial. Carriers are pouring money into things like advanced route optimization software to make their routes more efficient, real-time shipment tracking platforms so you, the customer, know exactly where your goods are.
That tracking is key for customers.
Definitely. And dynamic pricing engines that use artificial intelligence and machine learning to adjust rates based on network conditions and demand. It's estimated that 90% of all commercial truck fleets will utilize some form of optimization technology by 2025. 90%. So table stakes soon. Pretty much. Beyond that, you have digital freight matching platforms and digital brokerages disrupting traditional models, especially in that fragmented truckload market we talked about. They connect shippers and carriers directly using algorithms.
Cutting out the middleman, maybe?
To some extent. And in the warehouse, there's a growing focus on automation. Automated dimensioning and weighing systems, autonomous forklifts, robotics to streamline freight handling.
And that's where ArcBest's Vo comes in.
Precisely. ArcBest's proprietary Vogos technology suite is a prime example of a legacy carrier embracing this trend, trying to move from being just a technology consumer to a technology creator, which could be a significant differentiator if they pull it off.
Fascinating. So let's talk about the competitive arena itself, especially in LTL. You mentioned it's an oligopoly, meaning a small group of formidable players. Who are the key players ArcBest is really up against day to day?
Right. In the LTL market, ArcBest's ABF freight unit competes with some really formidable national and regional carriers. FedEx Freight is the largest by revenue, leveraging its huge network.
Okay, FedEx Freight is number one.
Then you have Old Dominion Freight Line, or ODFL, They're widely considered the best-in-class operator.
Best in class. Why?
They set the industry benchmark for profitability and service quality. A big reason is their non-union labor model, which gives them a significant structural cost and flexibility advantage. That translates to the lowest operating ratios in the industry.
Lowest or R, meaning most profitable. We'll come back to that.
Definitely. Then there's XPO, another major non-union competitor focusing intensely on service and network efficiency. Saia, Inc. is aggressively expanding its terminal network, trying to achieve full national coverage. And then there's Estes Express Lines, a large, privately held carrier that's been a major beneficiary of the market share reallocation after Yellow's exit.
So the Yellowcore bankruptcy wasn't just a temporary disruption, but truly a catalyst for structural change for the long run. You really think its impact will last?
I do. That's precisely right. And it's a crucial distinction. A typical recession brings lower volumes and pricing pressure for everyone, sure. But then when demand picks back up, capacity eventually returns. Yellow's bankruptcy in 2023 was unique because it permanently removed a significant competitor and a large chunk of capacity from the market.
Permanently gone.
Right. This has created a rare opportunity for the remaining, more disciplined operators like ODFL, Saia, and ArcBest to be more selective in absorbing freight and, critically, to potentially maintain better pricing discipline that would otherwise be possible in a weak demand environment.
Fewer players means more pricing power, maybe.
Potentially.
Yeah.
The long-term implication is that these stronger carriers are positioned to emerge from this recession with permanently higher market share and potentially a more rational and profitable, competitive and pricing landscape simply because there are fewer major players at the table.
That's a huge permanent shift. Okay, and what about the asset-light segment? Is the competition as concentrated there as it is in LTL?
No, not at all. The asset-light arena is far more fragmented. ArcBest's brokerage and logistics services face a vast field. This includes global giants like C.H. Robinson.
Everyone knows C.H. Robinson.
Right. The brokerage arms of other big asset-based carriers like J.B. Hunt, and then literally thousands of smaller non-asset-based 3PLs and freight brokers.
Thousands, wow.
Yeah. It's a much more diverse and competitive landscape than LTL, characterized by lower barriers to entry and, frankly, intense price competition. Much harder to differentiate sometimes.
So this is the dynamic, challenging battlefield. ArcBest operates on a market in flux, dominated by a few giants in its core business, but with new technologies and demands shifting the ground beneath their feet. The big question now is, how does ArcBest specifically position itself with its unique structure to navigate and win in this gauntlet? 2. ArcBest's competitive engine. A company-specific analysis.
Okay, so ArcBest operates through two primary segments, asset-based and asset-light. This dual structure is fundamental to its integrated logistics strategy.
The one-stop shop idea.
Exactly. It aims to offer customers a comprehensive suite of solutions, making them that one-stop shop for diverse shipping needs, from a single pallet to managing an entire supply chain.
Let's start with the asset-based segment. This is ABF Freight, their foundational less-than-truckload business, right? What really defines it?
Yes, that's their core, their foundation. ADF Freight generated approximately $2.7 billion in revenue in 2024, making it the 7th largest LTL carrier in the U.S.
Number 7. Still pretty big.
Oh, yeah. It operates an extensive national network of about 250 campuses and service centers. These are absolutely crucial for the complex hub-and-spoke model of LTL we talked about.
The nodes in the network.
Precisely. Think of these as strategically placed nodes in a vast neural network, constantly sorting and moving freight efficiently across the country. Now, a defining characteristic of ABF Freight is its unionized workforce. Drivers and dock workers are represented by the International Brotherhood of Teamsters.
The Teamsters relationship is key.
Absolutely central. Their value proposition is clear. High-quality, reliable LTL services, often commanding a price premium for complex or time-sensitive shipments because of that proven reliability and experienced workforce.
Okay, that's the asset-heavy side. And then there's the asset-light segment. How does that fit into the picture, and what kind of services does it actually offer?
The asset-light segment comprises a portfolio of logistics services that primarily use third-party capacity providers, other people's trucks and assets.
So they don't own the trucks for this part.
Mostly not. This includes truckload brokerage, which was significantly scaled by their 2021 acquisition of Mullo Solutions. We'll talk more about that. It also includes expedited logistics through Panther Premium Logistics for time-critical, often last-minute shipments.
Like really urgent stuff.
Exactly. Medical supplies, high-value goods, that kind of thing. They also offer managed transportation solutions where they oversee a client's entire logistics needs and other global and household moving services. This segment generated $341.9 million in revenue in Q2 2025.
And the margins are different here.
Yeah, because it relies on third-party capacity rather than ArcBest's own trucks, it's more exposed to the volatility of the spot freight market and generally operates with lower gross and operating margins compared to the asset-based segment. It's designed for flexibility and scale without heavy capital investment.
So they've got this dual structure. What about their competitive advantages, their moat? What truly sets ArcBest apart in this fierce market? What makes them hard to compete with?
There are several key advantages that make ArcBest difficult to replicate. First, and maybe most important, is network density.
That LTL network we talked about.
Exactly. Building a comprehensive national LTL network of 250 terminals and service centers requires immense capital investment and decades of time. You can't just conjure that up.
A huge barrier to entry.
Massive. This network is a significant, hard-to-replicate asset that enables efficient freight movement and broad geographic coverage across the U.S., which is essential for that complex LTL jigsaw puzzle.
Okay, network density is number one. What else?
Second, an integrated service offering. Their core strategy is to be that one-stop shop for customers, offering a full spectrum of services from LTL to truckload, expedited, and managed solutions.
Trying to keep the customer within the ArcBest ecosystem.
Precisely. This is designed to create stickier, more embedded customer relationships, making ArcBest an indispensable partner and generating valuable cross-selling opportunities. And they have some evidence it works. The company reports a high 99.5% retention rate from its top 50 customers.
99.5%. That's incredible retention for their biggest clients.
It suggests this sticky strategy is quite effective with their most important accounts, the ones they really focus on integrating with.
Okay, network, integrated service, what else?
Third, service quality. ABF Freight has a long-standing reputation for high-quality, reliable service on time, and damage-free delivery are absolutely critical for shippers, especially for high-value or time-sensitive goods.
Reputation matters in this business.
Hugely. This reputation is underpinned by their experienced, tenured, unionized workforce and ongoing investments in technology and training. They position themselves as a premium service provider.
And fourth, you mentioned tech.
Right. Fourth is technology and innovation. ArcBest has made a significant strategic commitment here, investing approximately $175 million annually. This investment is most prominently seen in their proprietary VOZ technology suite, designed to revolutionize freight handling and warehouse automation.
That's the potential game changer.
It could be. This focus on unique in-house tech aims to create a hard-to-replicate operational advantage that could fundamentally change how they operate and maybe even how they generate revenue down the line.
So with those advantages, how does ArcBest actually stack up against its peers when we crunch the numbers? Where do they stand in the LTL market, and what's the most critical metric we should be looking at to compare them?
Okay, numbers. ArcBest's ABF Freight is the number 7 LTL carrier in the U.S., with that 2024 revenue of $2.69 billion. That puts them behind market leaders like FedEx Freight, Old Dominion, XPO, and Saia.
So solidly in the top tier, but not the biggest.
Correct. Now, when we look at the operational metrics, particularly the operating ratio or OR, this is where crucial differences emerge. This is really the key number for LTL.
Okay, let's clarify operating ratio again, because you called it the most critical measure. What exactly is it measuring, and why is lower better?
Right. Operating ratio, or OR, is the financial heartbeat of an LTL carrier. Think of it like this. For every dollar of revenue they bring in, how many cents do they spend on operating expenses to earn that dollar?
Like running the trucks, paying drivers, terminal costs?
Exactly. Wages, fuel, maintenance, rent, everything it takes to move the freight. It's calculated as operating expenses as a percentage of revenue. So a lower number is better, indicating higher efficiency and profitability. You're keeping more of each dollar earned.
Got it. Lower OR, better efficiency. So what's ArcBest's OR, and how does it compare?
In Q2 2025, ABF Freight's non-GAAP OR was 92.8%. That means they spent 92.8 cents on operations for every dollar of revenue.
Okay, 92.8. Is that good or bad?
We'll compare that to Old Dominion, the industry's efficiency king, which posted an OR of 74.6% in the same period.
Whoa, 74.6 versus 92.8. That's a huge difference.
Massive. Or compared to XPO at 86.2%. ArcBest is substantially less profitable on this key metric, meaning they keep a much smaller portion of each revenue dollar. This persistent profitability gap is a primary reason for ArcBest's valuation discount relative to its peers. It's the elephant in the room, financially speaking.
That's a stark difference, almost 20 points versus ODFL.
Okay.
And you mentioned a strategic divergence between ArcBest and its competitors in terms of volume versus yield right now. What does that mean? Are they chasing different goals?
It's a calculated choice they're making, and it highlights a fundamental strategic trade-off in this current market. In Q2 2025, ADF Freight's daily shipments grew by a robust 5.6%.
That's good growth, especially in a recession.
It is, and it's directly related to them absorbing freight from the defunct Yellow Corporation. They're taking that share. However, their billed revenue per hundredweight, which is a measure of pricing or yield, actually decreased by 3.1%.
So more shipments, but less money per shipment.
Exactly. This indicates a volume over price strategy right now. They are actively taking on new business, perhaps business Yellow used to handle, even if it initially comes at a lower yield or lower price.
What's the thinking there? Why do that?
The bet is to secure long-term market share while it's available, fill up their network, and then over time optimize that freight mix and improve pricing as the market recovers. It's a land grab now, optimize later strategy.
So it's a long game, prioritize filling their trucks and their network now, even if it means thinner margins today. But what's the risk with that approach? Could that lower yielding freight end up being permanently less profitable?
That's precisely the risk. There's a genuine concern that this lower yielding freight could permanently dilute the network's overall profitability, or it might prove very difficult to reprice later, especially if the market doesn't recover as quickly or strongly as they hope.
Hard to raise prices once a customer gets used to a low rate.
Very hard. And this contrasts sharply with Old Dominion's approach. In the same period, ODFL's daily shipments actually decreased by 7.3%.
They let volume drop.
Yes, but their yield, excluding fuel surcharges, increased by 5.3%. This highlights ODFL's strategy of prioritizing price discipline and margin protection above all else, even if it means sacrificing some volume in the short term.
Wow, polar opposites. ArcBest chasing volume, ODFL chasing margin.
Diametrically opposed philosophies for navigating a freight recession. It's fascinating to watch.
And how is ArcBest's integrated logistics model, that one-stop shop, performing during this downturn? Is it providing that synergy they hoped for, acting as a buffer, or is the reality different in a tough market?
Well, during the current downturn, the integrated model appears to function more as a defensive tool than an offensive one, perhaps. The idea is to leverage the stable LTL customer base to cross-sell those more volatile asset-light services, creating that holistic solution.
Use the LTL relationship to sell brokerage or expedited.
Right. However, in this weak market, the asset-light segment has actually been a drag on overall profitability for a while. Now, management has been deliberately shedding unprofitable truckload business to improve its margins, which is a good operational move, getting leaner.
Focusing on profitable business.
Exactly. But it means the two segments are currently moving in opposite financial directions in terms of revenue trends. LTL shipments up, asset-light revenue contracting. This suggests limited positive synergy in the current environment.
So the parts aren't really helping each other right now.
Not as much as they likely would in a strong market. The true synergistic growth potential of the model, where the parts genuinely elevate the whole, is more likely to be realized in a strong, capacity-constrained freight market. That's when customers are willing to pay a premium for a single-source provider who can guarantee capacity, both asset-based and non-asset.
Makes sense. And for our listener, if you're looking at the data, like in Table 1, the LTL carrier competitive matrix provided in the analysis, you'll clearly see these differences laid out: the revenue, the shipment growth, yield trends, and especially those starkly different operating ratios. The numbers truly illuminate these different operational philosophies.
Indeed, the numbers tell a compelling story of strategic choices and trade-offs.
This operational deep dive shows a company making deliberate choices in a tough market, sometimes prioritizing market share over immediate margin. Now let's see how those choices have played out financially over time, spanning a century of cycles, and how ArcBest has weathered previous storms. 3. A century of cycles, financial performance and historical resilience.
Right. Looking at ArcBest's financial performance over the past 5 years or so really reveals a company that has truly ridden the waves of the freight cycle. You see impressive growth during the upswings and, frankly, resilience during the downturns.
Let's talk about the boom first. The pandemic era was wild for freight, wasn't it?
Absolutely unprecedented. ArcBest's consolidated revenues surged from $2.9 billion in 2020 to a record $5.3 billion in 2022.
Wow, nearly doubled in 2 years.
Pretty much. This impressive growth was fueled by that unprecedented freight demand we all remember, a very tight capacity market that allowed for strong pricing power across the industry.
Everyone needed trucks.
Everyone needed trucks, and they were willing to pay. Plus, ArcBest had the significant contribution from the Malo Solutions acquisition in late 2021, which rapidly scaled their asset-light segment right into that strong market. Perfect timing, it seemed then.
So they definitely caught the tailwind during the boom. But then, as the market cooled dramatically, what happened to those revenues? Did they fall off a cliff?
Well, as the freight market cooled in late 2022 and entered what most call a full-blown recession in 2023, ArcBest's revenues naturally declined. They navigated a challenging industrial economy and soft freight markets throughout 2024. For Q2 2025, consolidated revenue was $1.0 billion, which is a 5% decrease year over year, so still reflecting that persistent weakness.
Down 5%. But you mentioned a divergence between the segments.
Yes, and this really speaks to their strategic choices and the different market dynamics. The asset-based segment, ABF Freight, has shown resilience. Its Q2 2025 revenue was $713.3 million, roughly flat year over year.
Flat is pretty good in this market. How'd they manage that?
Because those market share gains, partly from the yellow core demise, and that 5.6% increase in daily shipments offset the pricing pressure they were facing. Volume helped stabilize revenue.
Okay, so LTL held up relatively well on the top line. What about asset light?
That's the contrast. The asset-light segment's revenue fell 12.9% on a per-day basis to $341.9 million. That reflects both the soft spot market rates in brokerage and that strategic decision by management to reduce less profitable truckload volumes. They chose to shrink that business a bit to focus on quality over quantity in a down market.
That segment divergence makes sense, given what we discussed earlier about the asset-light segment being more exposed to the spot market. How did this revenue fluctuation impact their profitability? Did those record revenues in 2022 translate to record profits? And how are margins holding up now?
Profitability followed a similar cyclical trajectory, as you'd expect. ArcBest achieved record annual net income in both 2021 and 2022. Non-GAAP net income reached $348.4 million. Or 13.66 cents per diluted share in 2022. That was the peak.
And what drove that peak profitability?
Strong pricing and high utilization in the asset-based LTL segment. ABF posted a record-low non-GAAP operating ratio during that period, meaning they were exceptionally efficient when demand was booming.
But then with the market softening, those margins got squeezed, right? How much of an impact did that have on the bottom line?
Precisely. In Q2 2025, consolidated non-GAAP operating income was $45 million. Down pretty significantly from $64 million in the prior year quarter.
Down by almost a third. Ouch.
Yeah. And the asset-based segment's non-GAAP operating ratio, that key metric, deteriorated by 300 basis points year over year to 92.8%. That reflects the dual impact of taking on that lower-yielding yellow freight and dealing with higher labor costs from the new union contract, both hitting margins.
So LTL profitability definitely took a hit. But you mentioned a silver lining in the asset-light segment's profitability, even though revenue is down.
Yes, this is a really significant point, actually. Despite its revenue decline, the asset-light segment showed a remarkable profitability improvement. It swung from a non-GAAP operating loss of $2.5 million in Q2 2024 to a profit of $1.1 million in Q2 2025.
From a loss to a profit, even with less revenue? How?
It's a direct result of management's strong cost controls and that decision to deliberately shed unprofitable business. It points to a structural improvement in cost discipline within that segment. They're getting leaner and meaner there, even if the top line is still under pressure from the market. It shows they can manage costs effectively in that part of the business.
That's a really positive sign for future profitability in asset light, even if the market stays tough. What about cash flow generation? Is that a consistent strength for ArcBest even when profits are down? Can they still generate cash?
Yes, it has been. And it's a hallmark of a well-managed cyclical business like this. ArcBest has a solid track record of generating cash flow through various market cycles. In the last 12 months, ending Q2 2025, the company generated $231.8 million in operating cash flow.
Okay, cash from operations is solid. What about after investments?
Even after accounting for $160.2 million in capital expenditures, necessary investments in their fleet and facilities, they still produced $71.6 million in free cash flow.
So cash left over after reinvesting in the business.
Exactly. This ability to consistently generate free cash flow, even during downturns, is a testament to the resilience of their business model, and it directly supports their long-standing capital return program.
The dividends and buybacks.
Right. In fact, ArcBest has maintained dividend payments for 23 consecutive years, which is quite remarkable in such a cyclical and capital-intensive industry like trucking. It shows discipline and confidence.
23 years is a long streak. That's a strong indicator of financial health and management's commitment to shareholders and their balance sheet. Are they well positioned financially to navigate continued uncertainty, or are they stretched thin with debt?
They maintain a solid balance sheet and adequate liquidity, which gives them flexibility. As of the end of Q2 2025, ArcBest had approximately $115 million in cash and total debt of $241 million, relatively low leverage.
Do they have access to more cash if needed?
Yes. They also have access to additional liquidity through a $250 million revolving credit facility and an accounts receivable securitization program. This provides them with the financial flexibility to navigate the current market conditions, continue investing in their strategic initiatives like VOS, and support organic investment, strategic M&A if the right opportunity comes along, and those consistent returns to shareholders. They have dry powder, if you will.
Okay, good financial footing. Now, you mentioned earlier that this isn't ArcBest's first rodeo with a freight downturn. How does management compare the current challenges to past severe recessions, like the global financial crisis of 2008-2009? Have they learned lessons?
Management has explicitly drawn parallels, which is helpful for historical context. They definitely remember 2008-2009. The key difference today, however, is ArcBest's strategic transformation over the last decade or so. They've moved from being a pure-play LTL carrier back then to the integrated logistics provider they are now.
So the asset-light segment is the big difference.
Exactly. The development of the asset-light segment was, in fact, a direct strategic response to the inherent cyclicality and capital intensity of the asset-heavy LTL business. The idea was to diversify their revenue streams and provide more levers to pull in terms of cost management and service offerings, theoretically making them more resilient through these cycles.
Has that diversification fully insulated them from the cycle this time around, or has it maybe introduced new forms of volatility they didn't have before?
Not fully insulated, no, as we've seen with the asset-light segment's revenue performance recently. While the core LTL business has become structurally more profitable than it was in past cycles, adding a large truckload brokerage business through acquisitions like Malo has also increased the company's overall exposure to the highly volatile spot market, where prices can swing wildly day to day.
So less reliance on LTL cycles, but more exposure to spot market cycles.
Potentially, yes. This has the potential to actually increase consolidated earnings volatility in some ways, which runs somewhat counter to the original diversification narrative of stabilizing earnings. It's a trade-off that has perhaps introduced new complexities. Our listener can see this laid out clearly in the analysis, particularly in Table 2, the ArcBest segment financial summary. It illustrates how revenue, operating income, and operating margin trends have shifted across both segments and the consolidated results over the past 5 years, really showing that diversification strategy in action, warts and all.
That financial overview truly shows a company navigating massive cycles with resilience, but also making clear strategic shifts, like that deliberate focus on profitability over revenue in the asset-light segment recently. Given those shifts, what specific initiatives is ArcBest now actively pursuing to drive future growth and navigate these complex waters? What are their active plays right now trying to move beyond just weathering the storm? 4. The path to growth. Strategic initiatives and opportunities.
ArcBest is certainly not just sitting back and waiting for the market to turn. They're making deliberate moves to secure their future in this dynamic environment. Let's talk about organic growth first.
Okay, so on the organic front, you mentioned they're actively seizing market share, especially with that void left by Yellowcore. How significant is this share gain, and what's the immediate challenge that comes with it?
Yes, the 2023 demise of Yellow created a massive, once-in-a-generation opportunity in the LTL space, and ArcBest has definitely been a direct beneficiary. That robust 5.6% year-over-year growth in daily shipments they reported in Q2 2025. That's concrete evidence of them successfully onboarding new customers and absorbing that freight from their former competitor. This is crucial for expanding their network density and footprint.
So getting the volume is step 1. What's step 2?
Step 2, and this is the critical challenge, is ensuring the profitability of this newly acquired freight. It's one thing to get the volume onto your trucks. It's another entirely to make it consistently profitable without sacrificing your network efficiency or dragging down your overall yield.
Right, because we saw their yield went down initially. So what's their plan to address that profitability challenge with all this new freight coming in? How do they make it pay?
Well, to that end, they've announced a 5.9% general rate increase, or GRI, effective in August 2025.
A GRI. That's basically an across-the-board price hike.
Essentially, yes, for certain types of freight and contracts. This signals a clear intent to improve the pricing of their network over time, pushing for better margins on the freight they're moving, including that new volume.
But will it stick? Can they make a 5.9% increase hold in this market?
That's the million-dollar question. The success of this GRI will be heavily dependent on the broader economic environment and, crucially, the pricing discipline of their competitors. If the market remains soft and competitors like Saia or XPO don't also raise rates significantly, ArcBest might find it challenging to fully realize those higher yields without losing some of that hard-won volume back. It's a very delicate balancing act.
Okay, so organic growth is about grabbing share and then trying to price it right. What about the integrated logistics model? That's supposed to be a central pillar of their long-term strategy, aiming to be that one-stop shop. How are they leveraging that vision right now?
The goal remains to leverage their strong, established relationships within the asset-based LTL customer base to cross-sell their full suite of asset-light services.
Like using the LTL door opener to sell brokerage.
Exactly. Truckload brokerage, expedited shipping, managed transportation. The aim is to become a more deeply embedded strategic partner for shippers. If you're already handling their LTL, why not handle everything else too? This should, in theory, increase customer retention and allow them to capture a larger share of wallet from those existing accounts.
And that 99.5% retention rate for top customers suggests it works for the big ones.
It certainly suggests stickiness at the highest level, indicating that for their most important accounts, this integrated approach is resonating and creating strong partnerships.
But you also highlighted that the two segments have been moving in opposite financial directions during this downturn. LTL shipments up, asset-light revenue down. Doesn't that raise questions about the practical effectiveness of this synergy during a market downturn? Is the one-stop shop truly providing a defensive advantage when parts of the shop are struggling?
It's a very fair point, and the numbers do raise that question. While the concept of synergy is sound, and it clearly works well during strong markets when capacity is tight, its effectiveness as a purely defensive mechanism in a downturn is currently less clear from the financial results. The ideal scenario is that they complement each other in all conditions, providing stability.
But that's not quite happening now.
Not perfectly. Right now, the asset-light portion, despite its recent profitability improvements through those cost cuts, hasn't yet fully offset the broader market weaknesses or demonstrably pulled through significant new LTL business just because of the integration. The true test of the synergy, where it really proves its worth, will likely come when the freight market fully recovers, and they can leverage both segments to their maximum potential in a seller's market.
Okay, synergy is maybe more of a fair weather friend right now. Now, shifting gears to what could be ArcBest's boldest play for the future. Their significant bet on technology, especially the VOC technology suite. Can you walk us through what this is and why it's being called such a wild card for the company's trajectory?
Right, VOS. ArcBest has made a significant and strategic commitment to innovation, investing that $175 million annually in technology. The VOS technology suite is absolutely the flagship of this effort. It's a proprietary, end-to-end system designed to fundamentally transform material handling in warehouses and, critically, at the loading dock.
Transform how? What's the big idea?
This represents a potential paradigm shift for ArcBest. It could move them from being primarily a consumer of technology, like most logistics companies buying software off the shelf, to actually being a creator and potentially a seller of technology. That's a massive leap for a traditional LTL carrier.
Going from trucker to tech company, that sounds like a genuinely massive pivot. What are the core components of VOS that make it so potentially revolutionary?
Okay, the VOS suite has three core interoperable components designed to work together seamlessly.
Yeah.
First, there's the VOS Freight Movement System. This is a patented platform-based system for mobile carts or dollies that allows for the loading or unloading of an entire 53-foot trailer in under 5 minutes.
Under 5 minutes?
Yeah.
For a whole trailer?
That's the claim. It's a dramatic improvement over traditional piece-by-piece manual handling, which can take much, much longer. It aims to drastically cut dock time and labor.
Okay, that's impressive. What's next?
Second, VOS Smart Autonomy. This is a system of autonomous mobile robots, or AMRs, think small, smart warehouse robots that can automate workflows within warehouses. They can move those mobile freight platforms used by the freight movement system around, enabling swarm processing and speeding up internal sorting without human intervention.
Robots moving the freight around inside.
Exactly. And third, VoVision. This is a forklift-mounted technology using advanced imaging and AI to capture accurate freight dimensions and images in real time, right as the forklift handles the freight, without disrupting workflows.
So it measures and photographs the freight automatically.
Yes, ensuring precise billing based on dimensions and weight and better tracking.
So just to put that in plain terms, they're essentially building a system that can empty an entire semi-truck in less time than it takes to brew a cup of coffee, using robots inside the warehouse to move the stuff around, and even measure everything automatically with AI on the forklifts. Is that the core disruptive idea here, radically speeding up and automating the most tedious parts of freight handling?
That's precisely it. The core idea is to automate and accelerate the most labor-intensive and time-consuming parts of the LTL operation, the handling of freight at the dock and within the warehouse. This improves efficiency, should reduce damage, and potentially lowers labor costs over the long term once it's fully scaled and integrated.
And it's already getting external validation, right? Awards and things.
It is, which is promising. The VOS Suite was named one of Time Magazine's Best Inventions of 2023 and a winner of Fast Company's 2024 Next Big Things in Tech Award. This recognition underscores the innovative nature of the technology and its potential impact.
Okay, so it's not just vaporware. What's the strategic upside here for ArcBest if Vox really takes off? Is it just about making their own operations better?
That's the really interesting part. The strategic upside is potentially enormous because Vox isn't just planned as an internal tool. It's being actively marketed as a standalone commercial product for other shippers and warehouse operators to buy and use in their own facilities.
Ah, so they want to sell the tech itself.
Exactly. This positions ArcBest to enter a new business model, competing not just with other trucking companies, but also with logistic technology and warehouse automation firms. The potential upside is substantial because successful technology companies command significantly higher valuation multiples than asset-intensive transportation companies.
Right. Tech stocks trade way higher.
Way higher. If Vox can gain commercial traction and become a meaningful revenue stream, it could be a powerful catalyst for a re-rating of ArcBest's stock, fundamentally changing how the market values them. It could truly be transformative, not just an operational improvement.
That sounds like high reward, a true swing for the fences. But I imagine it comes with equally high risk. What are the biggest hurdles to making Vox a commercial success selling it to others?
Absolutely. This high-reward strategy comes with equally high risk. ArcBest has a century-long history as a transportation operator, right? They move freight. They are not historically a seller of complex hardware and software as a service or SaaS solutions.
Totally different business model.
Completely. The company will need to build or acquire entirely new competencies in tech sales, implementation, ongoing customer support, software development cycles. It's a whole new world for them. It's a completely different sales cycle and customer base than they're used to serving with freight services.
So huge execution risk.
Massive. The path to significant revenue and profitability from Vox is, frankly, uncertain, and it's not yet reflected in the company's financial statements in any meaningful way. So it remains a key area execution risk that investors need to monitor very closely. It's a fantastic idea on paper, but the challenge of turning it into a successful commercial product is considerable.
The Vox technology is clearly a bold move, a potential game changer, but it's not the only way ArcBest is deploying its capital. Let's look at their broader capital allocation strategy. How do they decide where to put their money generally? The capital allocation strategy.
ArcBest's capital allocation strategy is pretty consistently focused on a few key areas. First, maintaining a modern, efficient fleet that's essential. Second, expanding and enhancing its network of service centers. And third, investing in differentiating technology like Vox's, but also other systems.
The basics plus the big bets.
Right. These are the necessary investments to maintain their competitive edge and service quality in that core LTL business while also trying to build for the future.
What kind of capital expenditures or CapEx are we talking about here? How much are they spending and what are the specific projects they're investing in right now?
For 2025, the company is guided for capital expenditures in the range of $225 million to $275 million, though management indicated they're trending towards the lower end of that range given the soft market conditions.
Pulling back a bit due to the economy.
It seems like it, being prudent. A significant portion of this spending is dedicated to fleet renewal. For instance, they added over 700 new Class 7 and 8 trucks in 2024.
Why buy new trucks now if the market is soft?
These investments are crucial not just for maintaining capacity, but also for improving fuel efficiency, reducing emissions, hitting those ESG goals, and lowering maintenance costs over the long run. Newer trucks break down less.
Okay, fleet investment makes sense. What else?
They also continue to execute their facility enhancement and growth roadmap. This involves renovating existing service centers with more efficient technologies like LED lighting, and sometimes expanding network capacity at key hubs to improve productivity and throughput. These are essential ongoing investments for any LTL carrier to maintain competitiveness and efficiency. You have to keep the network humming.
Got it. They also have a history of acquisitions, and the Malo Solutions case study seems particularly illuminating and maybe cautionary. It started with such high hopes back in 2021, but the outcome has been difficult, hasn't it?
It's a critical one to understand, yes, as it speaks directly to the challenges of M&A in a dynamic industry like logistics, especially timing. ArcBest acquired Malo Solutions in the fourth quarter of 2021.
Right at the peak of the freight market frenzy.
Exactly. The strategic rationale at the time seemed clear. Rapidly scale ArcBest's truckload brokerage business within its asset-light segment, capitalizing on that booming freight market. Malo was seen as a high-growth brokerage, expected to double its revenue to approximately $600 million in 2021.
So buy growth in brokerage.
Right. The deal was valued at $235 million in upfront cash, plus a substantial performance-based earnout, meant to incentivize Malo's management to hit future growth targets. The intention was to double ArcBest's available carrier capacity to over 70,000 partners, establish them as a top 15 U.S. truckload broker almost overnight, and provide access to Malo's strong relationships with large shippers. It was designed to significantly accelerate their diversification strategy.
That sounded like a promising move at the time, grabbing a fast-growing player in a hot market. But it seems the performance and integration challenges have been significant since then. What went wrong? Was it just bad timing with the market turning?
The timing was certainly unlucky, but it seems like more than just that. The integration of Malo has proven to be quite challenging. It coincided, as you said, with a severe downturn in the truckload brokerage market, which hit almost immediately after the deal closed.
Talk about bad timing.
Really bad timing. The asset-light segment, where Molo's operations reside, has experienced significant revenue declines and profitability pressure since the acquisition, largely due to that market downturn hitting the brokerage space hard. But reports suggest these market challenges were compounded by internal issues.
Internal issues? Like what?
Well, it culminated in the abrupt termination of Molo's founder and CEO in early 2025 due to what ArcBest publicly described as culture clashes. That usually signals significant integration friction.
Culture clashes. Never a good sign after an acquisition. And what was the ultimate financial outcome of those challenges? The analysis mentions a write-down of the earnout. That sounds like a big deal. What does that specifically signal to investors?
It's a very clear and negative signal. The performance of the acquired Malo business has fallen significantly short of the aggressive targets set back in 2021 when the deal was made. In its Q2 2025 financial filings, ArcBest disclosed that the contingent earnout consideration for Malo, that extra money tied to hitting ambitious adjusted EBITDA targets from 2023 to 2025, had been written down entirely. To zero.
Written down to zero, so they don't expect Malo to hit any of those original targets?
That's what it implies. It's a clear and significant negative indicator. It signals that ArcBest management no longer expects the acquisition to meet its original financial projections. This outcome inevitably casts a shadow over management's M&A track record, particularly their due diligence process and integration capabilities, and it represents a potential impairment of the substantial capital that was deployed. It essentially says, this major investment isn't going to deliver the return we promised you.
So a clear misstep there, a blemish on the record, which needs to be considered when evaluating their future capital allocation decisions. But despite that, ArcBest has maintained a consistent commitment to shareholder returns through dividends and buybacks.
Yes, absolutely. Despite the challenges with Malo, ArcBest has maintained a consistent policy of returning capital to shareholders. They have that impressive 23-year history of uninterrupted dividend payments, with the current quarterly dividend set at $0.12 per share. That demonstrates a strong commitment to income investors.
And buybacks, too.
Yes. In addition to dividends, management has been actively repurchasing shares. In the first half of 2025 alone, the company returned over $47 million to shareholders through a combination of dividends and share buybacks. As of the end of Q2 2025, $14.8 million remained on its existing share repurchase authorization, so they still have room to buy more.
So returning cash is still a priority.
It appears so. If you look at Table 3 in the analysis, the capital allocation summary, you can see how consistent that cash flow from operations has been over the years, enabling those returns despite the variable capital expenditures and that significant chunk of cash that went out for the Malo acquisition back in 2021.
Okay. So while capital allocation shows mixed results, especially with Malo, ArcBest is facing broader industry headwinds that continue to challenge its operations day to day. Let's unpack those recent challenges that have been hitting them since 2023. Recent challenges and industry headwinds, 2023-2025.
Yeah, the most overarching challenge ArcBest is navigating is definitely the prolonged freight recession. It began in earnest in late 2022 and has really continued its grip throughout 2023 and 2024 and into 2025.
It just won't let go.
It really hasn't. This has created a consistently challenging operating environment for all players in the industry, and ArcBest is certainly no exception. It's the defining feature of the market right now.
And what's been the direct financial consequence of that persistent recession for ArcBest? We saw revenue was down.
Right. It directly led to that 5% year-over-year decline in consolidated revenue in the second quarter of 2025, even with the new freight they're taking on from Yellow. The impact has been most acute in the asset-light segment, which, as we discussed, is more exposed to the volatile spot market. That segment saw its revenue decline by nearly 13% on a daily basis.
Ouch. Asset-light really feeling it.
Definitely. And while the core asset-based LTL segment has been more resilient due to those market share gains, it has not been immune to the broader pressures on pricing and freight mix. It's like trying to run through quicksand. Every step is harder across the board.
We talked about their volume over price strategy in LTL grabbing that Yellow share. How is that playing out with recent volume and pricing trends in practice? What's the ultimate trade-off they're making, and is it working?
Well, it's creating a very clear bifurcated trend, especially in the LTL segment. Daily shipment volumes are indeed growing up that 5.6% in Q2 2025, largely due to ArcBest absorbing freight from Yellow. So strategically, they are gaining market share, which is a win. But, as we noted, this volume growth has come at the expense of pricing. Revenue per hundredweight declined by 3.1% in the same period. This really highlights their strategic trade-off in stark terms. They are prioritizing building network density and securing new customer relationships in what is fundamentally a buyer's market right now.
Taking what they can get.
Even if it means accepting lower prices in the short term. The hope, the bet, is that once volumes solidify and the market turns, they can then push for better pricing on that larger book of business. But it's definitely a trade-off with near-term pain for potential long-term gain.
Beyond pricing pressures and soft demand, what about cost inflation? Is that squeezing their margins even further from the other side?
Absolutely. It's a double whammy. ArcBest continues to face significant cost pressures from multiple sources, which directly compress their operating margins. The most prominent driver is labor cost inflation.
The Teamsters contract?
Primarily, yes. Driven heavily by their new, more expensive collective bargaining agreement with the Teamsters Union. But it's not just wages. They also contend with elevated costs for new equipment, parts, maintenance, insurance. Everything involved in running a trucking fleet is more expensive now.
So costs are up, prices are pressured, tough spot.
Very tough. All of these factors eat into profitability, especially in an environment where pricing power is limited and they can't simply pass on all those increased costs to customers without risking losing that volume they just gained.
Let's delve deeper into that labor market and union contract because it truly sounds like a defining structural factor for ArcBest, maybe the defining factor compared to peers like ODFL or SAIA. What are the long-term implications of this new agreement signed in 2023?
It is perhaps the critical and defining aspect of ArcBest's operational landscape and cost structure. Their labor relations, particularly with the International Brotherhood of Teamsters, which represents ABF Freight's drivers and dock workers, are absolutely central. In July 2023, the company and the union ratified a new 5-year National Master Freight Agreement.
5 years of stability at least.
Yes, it provides labor stability through June 2028, which is a positive for planning and avoids near-term disruption. But that stability came at a significantly higher cost base.
Okay, what are the major economic provisions of this new contract that impact ArcBest's costs? And how do they widen that structural cost gap you mentioned compared to their non-union competitors?
The contract includes substantial wage increases in each of its 5 years, starting with a hefty $3.50 per hour increase in the first year alone.
$3.50 an hour raise. That's significant.
Very significant across thousands of employees. This solidifies ArcBest's position as a high-cost, high-service carrier. It means they will inherently operate with higher labor expenses than their non-union peers. Period.
Sure.
Beyond wages, there are increased company contributions to the Teamsters' health, welfare, and pension plans.
Benefits are expensive too.
Very. There's also a new profit-sharing bonus for employees that gets triggered when ABF Freight achieves specific annual operating ratio targets, incentivizing efficiency perhaps, and additional paid time off, including Martin Luther King Jr. Day and 2 extra sick days.
So it all adds up.
It all adds up. This new contract entrenches and widens the structural cost gap between ABF Freight and its primary non-union competitors like Old Dominion and Saia. This makes it absolutely imperative for ArcBest to successfully differentiate its service offering and leverage technology like Voxa to justify a premium price point. Because competing purely on cost is simply not a viable long-term strategy for them against those lower-cost players. They have to be better, not just cheaper.
And are there any technology limitations within the contract itself that could hinder their future innovation or efficiency efforts, especially given their big bet on tech with Voxa? Could the union deal slow them down?
That's another crucial aspect. Reports suggest the contract includes specific prohibitions against the use of inward-facing cameras in the truck cabs and, significantly, driverless autonomous vehicles during the term of the agreement.
No driverless trucks for ABF until at least 2028.
That appears to be the case under this contract. This is a crucial point because it could potentially limit the company's ability to adopt certain cost-saving or safety technologies that may become available and adopted by its non-union peers during the contract's term. While VOF focuses more on dock and warehouse automation, these restrictions in the core trucking operations could create a long-term competitive disadvantage if the industry widely adopts such innovations for efficiency or safety gains. It ties their hands technologically in some key areas.
That's a really important constraint to understand. And finally, what about the broader economic uncertainty that management keeps mentioning? Is it just general market softness, or are there specific economic indicators that are particularly worrisome for a freight company like ArcBest?
Management has consistently highlighted the uncertain macroeconomic outlook as a primary challenge, and it's more than just general softness they're seeing. Key concerns include persistent weakness in industrial production and the housing sectors.
Why those two specifically?
Because those are major sources of LTL freight. When factories slow down their output or new home construction stalls, less LTL freight materials, components, finished goods, needs to be moved. There's also ambiguity surrounding future interest rate policy by the Fed and the potential impact of international trade tariffs, which can create uncertainty for supply chains and investment decisions by their customers.
Creates unpredictability.
Exactly. All of these factors create a challenging environment for forecasting and strategic planning, making it harder for ArcBest and frankly everyone in the industry to predict when that full sustainable rebound might actually occur.
These headwinds are certainly significant, and they've definitely put pressure on the business, impacting revenue, margins, and strategy. But strong leadership can make all the difference in navigating such challenges. Let's look at ArcBest's management team and corporate governance. How are they steering the ship? 7, management quality and corporate governance.
Well, ArcBest has actually had a long period of stable leadership at the very top, which is often seen as a significant advantage in navigating complex, cyclical industries like logistics.
Who's been in charge?
The company has been led since 2010 by Chairman and CEO Judy R. McReynolds. She's a highly respected industry veteran with over 30 years of experience in transportation and logistics.
Long tenure. What's her legacy?
Under her leadership, ArcBest has undergone that significant strategic transformation we've discussed, shifting from being primarily a traditional LTL carrier to the diversified, integrated logistics company it is today. She's received numerous accolades for her leadership, including induction into the Arkansas Business Hall of Fame, recognizing her long-standing impact on the company and the industry.
Okay, but there's a pivotal leadership transition underway right now, isn't there? A changing of the guard.
Yes, a very significant but also very well-planned one, which speaks positively to their governance and succession planning. In July 2025, the company announced that Judy McReynolds will retire from the CEO role at the end of the year.
Retiring as CEO. Who's taking over?
The current ArcBest president, Seth Runzer, has been named as her successor. McReynolds will remain with the company as chairman of the board, ensuring strategic continuity and hopefully a smooth handover.
So Runzer is the new CEO. What's his background? Is he an outsider?
No. Quite the opposite. Runzer is a longtime company executive who's been deeply involved in operations for years. He previously served as president of ABF Freight itself, the core LTL business, and he played a key role in negotiating the recent Teamsters contract. He knows the nuts and bolts intimately.
So this shift from a strategy-focused CEO like Judy, who drove the diversification, to an operationally focused one like Seth, who ran LTL and negotiated with the union. What does that suggest about the company's future focus? Is it may be less about big new strategies and more about execution now?
That's a very perceptive read, and I think many analysts see it that way. The shift from a long-tenured, strategy-focused CEO like McReynolds to a new CEO with such deep operational background like Runzer does suggest a potential evolution in the company's immediate focus. With the broad, integrated logistics strategy now established, the emphasis may indeed be shifting more intently toward optimizing execution, improving those operating margins we talked about, and navigating the complex day-to-day industry landscape areas where Runzer clearly has extensive hands-on experience.
Moving from designing the ship to making sure it runs as efficiently as possible.
That seems like a reasonable interpretation. A move from broad strategic strokes to refining the operational brushwork, perhaps?
And the board of directors has also seen recent changes that enhance its industry expertise, correct? Adding someone new.
Yes, another positive governance move. Also in July 2025, ArcBest appointed Tom Albrecht to the board. He's a very well-known and highly respected figure in the transportation industry.
His background.
He has over 3 decades of experience, first as a prominent Wall Street analyst covering logistics stocks for years, and later as a logistics company executive himself. His addition brings a deep external perspective on industry trends, competitive dynamics, and financial strategy directly into the boardroom's oversight function. That's a significant value add, especially in a cyclical and rapidly changing market like this one. Having that outside expert view can be invaluable.
Okay, strong board addition. And finally, how transparent is ArcBest with the investor community? Are they engaging actively, particularly as they navigate these tough times and make big strategic bets like Vasa that need explaining?
They maintain a regular cadence of communication through the usual channels: quarterly earnings releases, conference calls, investor presentations, SEC filings. But in a significant move, I think, to enhance transparency and strategic communication, ArcBest also announced it will host its first Investor Day in over a decade on September 29, 2025.
An investor day, why is that significant?
Because it's a dedicated event where they can really lay out their long-term vision in detail. It's expected to provide investors with a much deeper insight into the company's long-term strategic priorities, its innovation roadmap, especially around VOC, and its financial targets. It's a clear signal of their intent to engage more thoroughly with the investment community and articulate their future vision, which is crucial as they undertake such significant strategic initiatives and navigate this leadership transition. They know they need to tell their story clearly right now.
With a new leadership era beginning, focused perhaps more on operations and a clear effort to communicate their strategy, let's turn our attention to how the market currently views ArcBest through the lens of valuation. Is their stock price reflecting their challenges, their potential, or perhaps a complex blend of both? 8. Valuation analysis.
Okay, valuation. ArcBest's valuation clearly reflects its position as a cyclical industrial company operating in a highly competitive market. It tends to react strongly to the prevailing economic winds and industry sentiment.
So what are the key multiples looking like right now?
As of mid-2025, the company's stock is trading at a trailing 12-month, or TTM, price-to-earnings PE ratio of approximately 10 to 14 times earnings. And its price-to-sales PS ratio is about 0.4 times revenue.
10-14x PE, 0.4x PS. How does that compare to its own recent historical averages? Is it cheap or expensive relative to its own history?
Those current multiples are actually below the company's own recent historical averages. Over the past 5 years, ArcBest's average PE ratio has been higher, around 16.4x, and its average PS ratio has been a bit higher too, around 0.5x.
So it's trading cheaper than it usually does. Why?
This compression in valuation multiples is quite typical for a cyclical company during an industry downturn. The market prices and lower near-term earnings and heightened economic uncertainty. It suggests investors are currently more focused on the immediate headwinds of the freight recession, the margin pressure, than perhaps the long-term potential or recovery story.
Okay, so the market is discounting it relative to its own history. How does that discount look when we compare ArcBest to its primary LTL peers like Old Dominion and Saia? Is it a small gap or something more significant?
Oh, the discount compared to peers is significant and persistent. It's not a new phenomenon. ArcBest consistently trades at a substantially lower valuation compared to its main LTL peers.
How substantial? Give us the numbers.
For instance, ArcBest's TTM-PE ratio of roughly 10-14x is significantly lower than Old Dominion's, which trades around 28-32x.
Wow, less than half.
Yeah, and Sai is around 25-29x. XPO is even higher at 32-40x recently. This discount is also very evident on an enterprise value to EBITDA, or EBITDA, basis. That's a metric often preferred for capital-intensive industries because it strips out the impact of debt and depreciation. ArcBest's EBITDA multiple is consistently less than half that of its higher-performing peers. It highlights a clear skepticism from the market about its relative profitability and growth prospects.
Why does this valuation gap persist so stubbornly? What's the central issue or issues for investors that leads to such a dramatic and consistent discount compared to its closest rivals?
This is truly the central question for anyone evaluating ArcBest stock. The gap is attributable to several structural factors we've discussed throughout this deep dive. First, ArcBest's unionized labor force, which results in a higher structural cost base compared to non-union peers.
The OR difference.
Exactly. That leads to the second factor. Its historically lower operating margins and lower returns on invested capital compared to best-in-class non-union peers like ODFL. And third, you have the more recent concerns around the execution and financial performance of its strategic initiatives, particularly the struggles and write-down related to the Mullo acquisition.
So higher costs, lower margins, and some M&A questions.
Pretty much. Investors are essentially saying, you're a decent LTL operator with a great network, but you're fundamentally less efficient than your best competitors, and your recent big acquisition hasn't delivered. You can see this stark contrast laid out clearly in Table 4 in the analysis, the comparative valuation multiples table. It visually highlights the wide differences across PE, forward PE, EV sales, EV/EBITDA, and price-to-book value. The discount is everywhere.
Given that ArcBest has these two distinct business models, asset-based LTL and asset-light logistics, would a sum of the parts, or SOTP analysis, be a useful way to think about its underlying value? Could the parts be worth more separately?
Yes, an SOTP analysis is a very relevant valuation framework for ArcBest precisely because of those two distinct segments. It helps you think about what each piece might be worth on its own.
How would that work?
This approach values each segment independently based on the typical valuation multiples of its pure-play peers, and then you sum them up to arrive at a theoretical total enterprise value.
So value LTL against LTL peers and asset-light against brokerage peers.
Exactly. The asset-based or LTL segment would likely command a multiple at the low end of the LTL peer group range, or maybe even at a discount to that low end because of its lower profitability and unionized structure compared to ODFL or SAIA. The asset-light segment would be valued against freight brokerage and 3PL multiples, again likely at the lower end of that range, perhaps 5x EBITDA or even less, given its recent profitability challenges and the Mullo issues.
Could doing that SOTP calculation reveal if the market is applying a conglomerate discount, penalizing them for being two businesses in one?
It absolutely could. An SOTP analysis might reveal that the sum of the theoretical values of the two parts is actually higher than ArcBest's current total market valuation. If that's the case, it suggests the market is applying a conglomerate discount, valuing the combined entity at less than the sum of its parts, essentially penalizing them for the complexity or perceived lack of synergy between the two businesses under one roof.
Interesting. And when you're valuing a cyclical business like this, especially one in a downturn, you mentioned that looking at current earnings can be misleading because they're often at a trough. What's a better approach for investors to get a clearer picture of ArcBest's true underlying earning potential?
Yeah, it's critical to avoid valuing a cyclical business like ArcBest based solely on current or near-term trough earnings. That can be very misleading and can significantly undervalue the business over a full economic cycle. A more appropriate approach is to try and estimate the company's normalized earning power.
Normalized earnings, what does that mean?
It involves assessing what the company's profitability and earnings would likely be under more typical mid-cycle economic conditions, not just the current depressed environment. You try to smooth out the peaks and troughs.
How do you estimate that?
One way is by applying historical mid-cycle operating margins, which would be somewhere between their recent peak margin, like the 9.1% consolidated OR in 2022, and their current trough margin, like the 4.5% in 2024, to the company's current larger revenue base. This gives you a more stable, representative earnings figure that isn't overly influenced by the temporary extremes of the industry cycle.
So it provides a more reliable base for valuation.
Exactly. This normalized earnings figure then provides a more reliable basis for applying a valuation multiple, giving you a potentially truer sense of the company's intrinsic value over the long haul, rather than just its value in today's tough market.
So the market clearly sees a discount driven by structural issues like the union contract and recent missteps like Molyneux. But what are the potential pitfalls that could make that discount persist or even deepen? Let's talk specifically about the risks ArcBest faces going forward. 1X, risk assessment.
An investment in ArcBest, like any company, is certainly subject to a number of risks. These range from broad industry risks to things very specific to ArcBest's own operational and financial structure. Understanding these is absolutely crucial for assessing their future prospects.
Okay, starting with the big picture. What are the cyclical and macroeconomic risks that ArcBest can't really control but will profoundly impact its performance no matter what they do?
Right. The biggest one is simply that the company's financial performance is highly correlated with the health of the broader economy, especially the industrial sector. This means a prolonged economic downturn, a deep recession specifically hitting manufacturing, their key LTL customer base, or even just a sustained decline in consumer spending on goods would inevitably lead to lower freight volumes and increased pricing pressure across all their segments.
So if the economy tanks, they suffer.
Pretty much unavoidable. It directly impacts ArcBest's revenue and profitability. They are fundamentally tied to the ebb and flow of overall economic activity.
And competitively, what are the major risks? You've highlighted that difference in operating ratios and the cost structure with their non-union peers. How does that translate to risk?
That's precisely it. The LTL industry is intensely competitive and becoming more so. ArcBest faces significant, ongoing competition from larger, more profitable, and non-union carriers like Old Dominion and Saia. As we've discussed, those carriers possess a structural cost advantage due to their lower labor costs and potentially greater operational flexibility.
So they can undercut ArcBest on price.
They have more room to, yes. If ArcBest fails to consistently maintain its superior service levels or cannot effectively justify its premium pricing, that whole value proposition we talked about, it could lead to a permanent loss of market share to these lower-cost competitors, especially on more price-sensitive freight. It's a constant battle to prove their value justifies their price.
What about operational risk within ArcBest itself? We've talked extensively about the labor relations and the new Teamsters contract. How does that translate into ongoing risk beyond just the cost?
Labor relations are a constant and defining operational risk for ArcBest, baked into their model. While the 2023 agreement with the Teamsters provides 5 years of stability, which is good, future contract negotiations are always a recurring and significant event on the horizon. You have to think about 2028 already.
What's the risk in negotiations?
A potential work stoppage, a strike during a negotiation period could be highly disruptive and extremely costly, potentially crippling operations even for a short time and damaging customer relationships. Furthermore, as we noted, specific provisions within the current contract may limit their ability to adopt certain cost-saving or safety technologies, like inward-facing cameras or driverless autonomous vehicles.
Creating a potential tech gap.
Exactly. This could create a long-term competitive disadvantage for ArcBest compared to non-union peers who might embrace those innovations more freely and quickly during the next few years.
And what about execution risk for their own strategic initiatives, especially with big bets like VOC and considering the past challenges with integrating MALO?
That's a very significant risk, and it's arguably the one most directly controllable by management, making it key to watch. The challenges encountered with the integration of MOLO solutions clearly highlight the difficulties and inherent risks of large-scale mergers and acquisitions, especially when they coincide with market downturns or involve cultural differences.
M&A is hard.
Very hard to get right. Similarly, the commercialization of the VOS technology suite is a major undertaking in what is essentially a new business area for the company selling tech, not just using it. Its success is by no means guaranteed. It requires building entirely new competencies, as we discussed. Failure here would be a major strategic setback.
Any other operational risks?
Well, there's also the broader industry-wide risk of qualified driver and dock worker availability. Shortages can lead to ongoing wage inflation beyond contract terms and create capacity constraints that could affect service levels for everyone, including ArcBest.
Are there specific financial risks to consider as well, beyond just the impact of the freight cycle on earnings?
Yes, a couple worth mentioning. ArcBest contributes to several multi-employer pension plans for its unionized employees. These plans, while common and unionized industries are subject to funding volatility based on market returns and demographics. While recent legislation had provided some near-term relief to some plans, the long-term health of these funds and ArcBest's future contribution obligations remain a financial risk that can be somewhat unpredictable and potentially large.
Pension funding is complex. Anything else?
Also, while their debt is currently manageable, any significant increase in debt levels, perhaps for another large acquisition or massive capex or just a sustained period of much higher interest rates, would raise their financing costs and reduce their financial flexibility for future investments or shareholder returns. Standard financial risk, but important in a capital-intensive business.
And finally, what about technology and regulatory risks beyond what we've already covered with decarbonization and the union contract limits? Anything else on that front?
The logistics industry is just undergoing such rapid technological change, even beyond what ArcBest is doing with Voco. ArcBest faces the constant risk of being outpaced by more technologically advanced competitors, maybe smaller, nimbler players, or entirely new disruptive digital brokerage platforms that emerge and manage to streamline parts of the supply chain more effectively or cheaply.
Disruption is always a risk.
Always. And on the regulatory front, beyond decarbonization, there are always potential changes in safety regulations, hours of service rules for drivers, or infrastructure policies that could impact costs and operations for the entire industry. And that long-term transition to zero-emission vehicles, while distant, will require massive capital investment across the board for new trucks and new fueling infrastructure, presenting significant operational and financial challenges as viable solutions and the necessary infrastructure are still evolving. It's a massive industry-wide transformation they have to navigate over decades.
Okay. We've covered a lot of ground: the industry, ArcBest's strategy, its financials, the tech bets, the risks. Let's bring it all together now to synthesize this and answer the key questions facing anyone looking at ArcBest today.
Answering the key questions.
All right, so after this comprehensive analysis, let's try to synthesize the findings and directly address those central questions facing anyone looking at ArcBest.
Okay, first big question. How sustainable is ArcBest's competitive position in an increasingly consolidated LTL industry, especially given its unique unionized structure and cost profile? Can they keep competing effectively?
I'd say ArcBest's competitive position is moderately sustainable. It's firmly anchored by the significant barriers to entry created by its dense national LTL network. That network is a formidable asset, very hard and expensive to replicate. But that position is under constant pressure because, as we've hammered home, the company is structurally disadvantaged on cost relative to its primary non-union peers, who consistently generate higher margins and returns on capital. Therefore, ArcBest's long-term sustainability isn't guaranteed by its network alone. It's critically dependent on its ability to successfully execute its differentiation strategy.
Meaning they have to be better, not just cheaper.
Exactly. Leveraging its integrated service model and, perhaps most importantly, its investments in unique technology like Vox, they need that to create a premium value proposition that customers are willing to pay a premium for, thereby justifying its higher inherent cost structure. Without that strong differentiation, that significant cost gap becomes a major vulnerability over the long term.
Okay. Moderately sustainable but dependent on differentiation. Second question. What is the company's normalized earning power through a full freight cycle? What could they earn in a normal market, smoothing out these peaks and troughs?
Well, the company's current earnings are certainly below its normalized potential, reflecting this cyclical downturn we're in. A normalized earnings analysis, like we discussed, would consider ArcBest's larger post-pandemic revenue base and apply a more typical mid-cycle operating margin.
Somewhere between the recent peak and the current trough.
Right. Somewhere between that 9.1% consolidated ORR they hit in the 2022 peak and the 4.5% trough in 2024. That kind of analysis would suggest a significantly higher earning power than what they've reported in the last 12 months. Considerably higher. Potentially.
But that potential isn't guaranteed, right? What does it depend on?
Absolutely contingent on a few key factors playing out. First, the asset-light segment must return to sustained, meaningful profitability, not just break even like recently, but contribute significantly. Second, the asset-based LTL segment must successfully defend the majority of its recent market share gains from Yellow without permanently impairing its yield profile, meaning they need to eventually get better pricing on that new volume they grabbed. It's a conditional potential that really hinges on solid execution coming out of this downturn.
Third question. How effectively has management allocated capital to drive shareholder value? We saw the good dividend record, but also the Marlowe issue. What's the overall grade?
It is indeed a mixed record, with some clear successes and one significant undeniable misstep recently. The company has demonstrated a strong and consistent commitment to shareholder returns through those uninterrupted dividends and opportunistic share repurchases, which is a clear positive for investors seeking yield and capital discipline.
And the internal investments.
Their organic capital expenditures seem focused, and necessary spending on fleet modernization and network enhancements are essential table stakes for their core LTL business. However, the 2021 acquisition of Mello Solutions stands out as a significant blemish on that record.
The timing, the integration, the write-down.
All of it. The subsequent performance issues, the leadership turnover, and the recent write-down of the earnout to zero strongly suggest that the substantial capital deployed in that transaction has not generated its expected return and may, in hindsight, have been a misallocation of capital. It didn't work out as planned.
What does that Mullo experience mean for future strategy?
It places a much greater onus, I think, on the company's large internal investment in the VOC technology to succeed and generate high returns. VOC really needs to work out now to validate the overall capital strategy as value accretive and show they can generate good returns on big investments.
Okay, mixed record on capital allocation. Fourth question, what are the most significant catalysts that could drive future outperformance or underperformance for ArcBest stock? What should investors be watching for most closely?
Okay, catalysts. For outperformance, the primary catalyst, honestly, would be a strong freight market recovery, especially in the industrial economy. That would bring significant operating leverage and pricing power back to the LTL segment, boosting profitability significantly.
A rising tide lifts all boats, especially cyclical ones.
Exactly. Second, the successful commercialization of VOCs. We need to see tangible evidence of external revenue generation and customer adoption. If that happens, it could trigger that fundamental re-rating of the company as a technology-enabled logistics provider, changing its investment profile entirely. And third, just sustained margin improvement, demonstrating an ability to consistently close that operating ratio gap with peers through ongoing efficiency gains and pricing discipline, proving they can execute better.
Okay, those are the upside catalysts. What about the downside? What could cause the stock to underperform?
For underperformance, the biggest risk is probably a prolonged or even a double dip freight recession. That would continue to pressure margins and make it very difficult for them to maintain the profitability of their newly acquired market share. Second, the failure of VOCs to gain commercial traction. If it doesn't translate from an award-winning concept into a profitable business line, it would represent a significant squandering of their R&D investment and a major missed opportunity for that re-rating. And third, continued struggles in the asset-light segment specifically. An inability to return the brokerage business to consistent, meaningful profitability would make it a persistent drag on consolidated results, undermining the whole diversification strategy.
Makes sense. Finally, the fifth key question. How does the current valuation, with that steep discount to peers, reflect the company's intrinsic value and future prospects? Is the market being overly pessimistic or just realistic about the challenges?
I think the current valuation, that steep discount to LTL peers on virtually every metric, accurately reflects the market's perception of ArcBest's structural challenges and its recent strategic missteps. The market is clearly pricing in those higher costs and potential inflexibility of the unionized labor force, the persistent profitability gap with best-in-class competitors, and the disappointing results so far from the Mallow acquisition.
So the discount reflects reality.
It reflects the current reality and the perceived risks, yes. Therefore, an investment decision in ArcBest today is fundamentally a judgment call on whether you believe management can successfully overcome these known challenges.
Is there any margin of safety at this valuation?
The current valuation does provide something of a margin of safety against these known risks, meaning perhaps there's less downside if things don't dramatically improve, as much of the bad news seems priced in. However, the potential for the stock's valuation to rise and approach its intrinsic value, which is likely higher than its current trading level based on normalized earnings potential, is entirely contingent on management successfully executing its strategic plan.
They have to deliver.
And they have to deliver. They need to prove that the integrated model can deliver tangible synergies, that the new LTL market share can be made profitably sticky over time, and, most critically, that the significant investment in technology like VOCs can create a durable competitive advantage and potentially a new source of high margin growth. Failure to deliver on these fronts would suggest that the current valuation discount is justified and likely to persist. The ball is in their court to prove the doubters wrong.
We've seen how ArcBest is navigating a truly demanding freight environment, balancing its traditional unionized LTL powerhouse with an agile, asset-light segment, and making a very bold bet on advanced technology like VOS. This deep dive reveals that even in mature, seemingly traditional industries like trucking, innovation, and strategic adaptation are not just about growth, but about survival and fundamentally reimagining what's possible.
It's a constant evolution.
Absolutely. So as you, our listener, reflect on ArcBest's journey, its deep roots, its current challenges, its ambitious bets, consider this. What might be the next unexpected wildcard technology or market shift, maybe something we haven't even discussed today, that could completely redefine success in this critical logistics industry, perhaps emerging from an entirely unexpected corner?
It's a compelling question, and one that forces us to look beyond the immediate cycle to truly understand the long game in logistics. What's the next Vox? Or the next yellow bankruptcy?
Exactly. Constant change. Thank you for joining us on this deep dive.